Have you ever stopped to think about what happens to, say, a company's delivery trucks or factory machines once they're done? We talk a lot about buying them, using them, depreciating them, but that final step, when these really valuable assets hit the end of the road, what actually happens then, it's definitely more involved than just, hauling old equipment away. Understanding how companies handle this disposal, it can tell you a surprising amount. And that's exactly what we're going to get into today. This deep dive is all about that final, often overlooked chapter, asset disposal. We'll unpack how businesses account for getting rid of these fixed assets, whether they just discard them or manage to sell them, and how that whole process leads to either a gain or sometimes a loss on the books. Our mission is pretty straightforward. Simplify this, give you a clear step-by-step guide to those journal entries so you can really grasp what's going on financially. Before we dive deeper, though, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, the explanations we'll talk through today, they're all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, do check out the website. They've got additional practice questions, video lectures, and really detailed support to help reinforce today's topic. A special thanks to Professor Farhat for providing this valuable material. Okay, so let's unpack this. When we say an asset's useful life is over, what are the real options for a company? How do they actually get it off their hands? And what does that mean right away for the accounting side?
Well, it's interesting because generally a company has two main routes they can take when an asset is no longer useful. First, they can just discard it, basically throw it away. This usually happens if it has absolutely no market value left, or maybe it can't be repurposed, or it's just too beat up. Think of an old specialized machine that nobody wants, not even for scrap parts.
Okay, so it's gone.
Right. The second path, which is probably more common, is selling the asset, trying to get some cash for it. And this is where you almost always see those gains or losses popping up on the financial statements.
Wait, so even if they just discard it, like toss it in a dumpster, there could still be a gain or loss recorded. I sort of assumed discarding meant, zero impact after depreciation.
Yeah, that's a really common thought, but you're right, it still has an impact. Whether it's discarded or sold, the fundamental accounting doesn't change. You absolutely have to remove the asset from the balance sheet. And just as importantly, you have to remove its related accumulated depreciation. Those two accounts, they're tied together. If the asset's gone, its accumulated depreciation has to go too. So our goal today is really to show you how to figure out that gain or loss and understand the journal entries that make it all official on the books.
All right, makes sense. So how do we actually do this? The source material we're using lays out 5 pretty clear steps for disposing of plant assets. Let's maybe walk through them. Step 1 seems foundational. Make sure depreciation is totally up to date. Why is that the absolute first move? Why is it so critical to get that depreciation perfect before doing anything else?
That's a great question to start with, because the accuracy of everything that follows hinges on this first step. You need a precise, up-to-the-minute book value. Remember, book value is just the asset's original cost minus all the accumulated depreciation taken so far. That book value, that's your benchmark. It's what you compare the selling price against to figure out if there's a gain or loss. If your accumulated depreciation number isn't current, well, your book value is wrong. And if the book value is wrong,
Then your gain or loss calculation is going to be wrong too.
exactly, your financial statements won't accurately reflect what really happened with that disposal.
Okay, so let's say a company has an asset, and at the end of last year, year 5, the accumulated depreciation was, say, $30,000. But they decide to get rid of it halfway through this year, year 6. They can't just use that $30,000 figure then, can they?
No, absolutely not. They first have to record the depreciation expense for that first half of year 6. Maybe it's another $3,000 for those 6 months, just as an example. So the updated accumulated depreciation becomes $33,000. That's the number they use to calculate the correct book value as of the disposal date. Without that update, like you said, the gain or loss would be off.
Got it. So depreciation is current, book value is accurate. What's next? Steps 2 and 3 seem to be about removing the asset and its accumulated depreciation from the books, kind of like undoing the original setup. How does that work with debits and credits?
Yeah, you can think of it like that, like reversing its presence on the balance sheet. Assets, normally have a debit balance. So To remove an asset to make its balance zero, you have to credit the asset account for its original cost.
Okay, credit the asset.
And accumulated depreciation. That's what we call a contra asset account. It sits on the balance sheet, but has a normal credit balance because it reduces the asset's value. So to get rid of that accumulated depreciation balance, you do the opposite. You debit the accumulated depreciation account for the total amount accumulated right up to the disposal date.
Debit accumulated depreciation.
Right. These two entries, crediting the asset, debiting its accumulated depreciation, they are always part of the disposal entry. You have to do them whether it's a sale or just discarding it.
Okay, now step 4 brings in the cash.
Mm-hmm.
This is where it gets really interesting, I think. Because sometimes you get cash, maybe sometimes you even have to pay someone to take the asset away, right? Like a disposal fee. How does that fit in?
Exactly. Step 4 is all about reflecting the actual cash flow. If you sell the asset and get cash, simple enough, you debit your cash account because your cash balance increased.
Debit cash for cash received. Makes sense.
But like you said, sometimes you might have to pay to get rid of something. Maybe there are dismantling costs or environmental cleanup fees. In that case, you'd actually credit the cash account, showing that cash is flowing out of the company related to this disposal.
Huh. Okay, so cash can be a debit or a credit, depending on whether money comes in or goes out.
Precisely. It just mirrors the reality of the transaction.
And then, the moment we've been building up to, step 5, figuring out the gain or loss. This is the big reveal, isn't it? How do we actually calculate if the company came out ahead or took a hit on this disposal?
This is where it all comes together. You compare the asset's final accurate book value, that cost minus updated accumulated depreciation, to the amount of cash you received, which you just recorded in step 4. There are basically 3 possible outcomes here. First scenario, no gain or loss. This happens if the cash you receive is exactly equal to the book value. Say the book value was $12,000 and you sold it for exactly $12,000. Then there's no gain, no loss. The journal entry just balances perfectly with the cash debit, the accumulated depreciation debit, and the asset credit.
A clean break even.
Exactly. Second scenario, you have a gain. This happens if the cash received is greater than the book value, using that example. Maybe the book value was $12,000, but you managed to sell it for $14,000. That extra $2,000, that's a gain. In the journal entry, you record this gain as a credit. We usually call the account something like gain on disposal of assets, gains increase equity, kind of like revenue does.
Okay, a credit for a gain.
And the third scenario, you have a loss. This occurs if the cash received is less than the book value. So if the book value was $12,000, but you only got $10,000 for it, you've incurred a $2,000 loss. A loss is recorded as a debit in the journal entry, often to an account like loss on disposal of assets. Losses decrease equity, similar to how expenses do.
A debit for a loss. Got it. That really clarifies the mechanics. Let's try putting this into practice. Our source material gives a nice simple example. A machine that originally cost $8,000. Over its life, it accumulated $7,000 in depreciation. So cost $8,000 minus accumulated depreciation, $7,000. Its book value is $1,000.
Perfect. $1,000 book value. Now remember, in every single scenario we look at for this machine, 2 things will always happen in the journal entry. We will credit the machine account for $8,000 to remove it.
Right, the original cost.
And we will debit accumulated depreciation for $7,000 to remove that balance. Those are constant. It's the cash and the gain loss part that changes.
Okay, constants are set. Scenario 1. The company just discards it, throws it away, gets 0 cash. What's the journal entry look like?
Okay, book value is $1,000. Cash received is $0. So the difference is a $1,000 loss. The entry would be debit accumulated depreciation, $7,000. Debit loss on disposal of asset, $1,000. And credit machine, $8,000. The debits, $7,000 plus $1,000 equal the credit, $8,000. The loss fills the gap because no cash came in.
Straightforward loss.
Yeah.
Okay, scenario 2. What if they manage to sell it but only get $800 for it? Still less than the book value.
Still less, exactly. Book value, $1,000. Cash received, $800. That means they're short by $200, so it's a $200 loss. The entry this time. Debit cash, $800. Debit accumulated depreciation, $7,000. Debit loss on disposal, $200. And credit machine, $8,000. Again, the debits, $800 plus $7,000 plus $200 plus $7,000 plus $1,000. Oh, wait, let me rephrase. The debits, $800 plus $7,000 plus $200, total $8,000, balancing the credit to machine for $8,000.
Wait, the loss is smaller, but it's still there. Now, scenario 3. They sell it for exactly $1,000, right on the book value. This feels like hitting the target exactly.
It is. Book value $1,000, cash received $1,000. The difference is zero, no gain, no loss. So the income is just. Debit cash $1,000, debit accumulated depreciation $7,000, and credit machine $8,000. See how the debit's $1,000 plus $7,000 perfectly match the credit $8,000. No need for a gain or loss account here.
Nice and clean. Okay, final one, the dream scenario. Selling it for more than book value. Let's say they get $1,200. What happens now?
Yeah. Now we have a gain. Book value $1,000, cash received $1,200. They got $200 more than its value on the books, so it's a $200 gain. The journal entry. Debit cash $1,200. Debit accumulated depreciation $7,000. Then credit machine $8,000. And credit gain on disposal of asset $200. Check the balance. Debits $1,200 plus $7,000 take $200. Credits $8,000 plus $200 plus $8,200. It works out perfectly with the gain recorded as that credit.
That makes perfect sense. Walk through it like that.
Yeah.
So bringing it all together, what does this mean for you, the listener, whether you're deep in accounting studies or just sort of curious about business finance? Why does mastering these disposal entries actually matter?
Well, stepping back to the bigger picture, understanding these disposal entries is really quite crucial if you want to properly interpret a company's financial statements. They tell a story that goes beyond just buying and using assets. For example, if you see a company consistently reporting losses on asset disposals year after year, that might be a red flag. It could signal issues. Maybe they're buying assets that don't hold value, or maybe their asset management strategy isn't great, or perhaps it reflects tough market conditions for used equipment in their industry.
Interesting indicator.
Yeah. And conversely, if a company consistently reports gains on disposal, that could suggest they're really effective at using their assets. Maybe they make smart purchasing decisions, perhaps they maintain them well, or maybe there's just a really strong secondary market for their type of equipment. It can actually be a sign of operational efficiency or even a bit of a competitive edge. So these entries, they add a layer of context to the numbers you see. They give you a deeper insight into the business's operations and strategic choices.
So we've just worked our way through what seems like a simple topic, getting rid of old stuff, but it's actually surprisingly nuanced, isn't it? This whole world of fixed asset disposal, it really does tell a story about how a company manages its resources, its efficiency, maybe even how well it understands its market. We covered the why behind disposal, went through those 5 key accounting steps, and walked through concrete examples showing gains, losses, and just breaking even.
And maybe that leads to a final thought for you to ponder. How might a company, thinking strategically, actually time its asset disposals? Could they potentially manage their reported earnings by choosing when to sell assets that might result in a gain or a loss? And what kind of signal might that send to investors or analysts about their overall financial management approach? Something to think about.
That's a fascinating angle. Definitely something to chew on. And for those of you looking to really lock this knowledge down, maybe work through more exercises or get ready for exams, don't forget farhatlectures.com. They have comprehensive resources, video lectures, tons of multiple choice questions, practical exercises on this topic, and really all things accounting. It's a great place to solidify your understanding. Thank you so much for joining us on this deep dive today. Until next time, keep learning and definitely keep asking those interesting questions.